Hello. The company being analyzed today is Gokul Agro Resources. This company is involved in the manufacturing of edible oil, non-edible oils, and their byproducts. So it's involved in that industry. Today, we're going to analyze the company's financials, what the company actually does, its production capacity, its balance sheet, and more important information, including its cash flows. So disclaimer, I own some of the stocks in this company, so I am biased towards this company. I obviously want the company to succeed. So all the information presented here, please do recheck them. And of course, this is not financial advice. I'm not registered as a financial advisor. So let's start. First, you have the market cap. 5,871 crores is the current market cap right below me. So it's a bit of a small cap of a company. Then the current price of one share is 398 rupees. The book value per share is 70.2 rupees. Book value is total assets minus total liabilities. So book value per share is 70.2 rupees. The return on equity, ROE, right below me is a very high 27%. Return on capital employed below me is a really high 34.2%. And the stock's price to earnings ratio, PE, is 22.2. So PE is 22.2 and the light went away. Hold on. Okay, I'm going to edit that. 3, 2, 1, edited. So extremely high return on equity and return on capital employed numbers. Now, let's take a look at the company's financials. Here we have the company's profit and loss all the way 2016 to 2025. Here we have sales. Here you can see we have operating profit. We have the operating profit margin, profit before tax, and finally profit after tax. All right. Now, one thing straight up, look here. OPM, below me, OPM, 1%, 2%, 2%, 3%. This company, like every other edible oil company, is a very low margin company. So the profit margins are extremely small. And even among its competitors, it has one of the lower profit margins. So keep in mind, one of the lower profit margins among its competitors, though the profit margins are on the rise. So in 2016, we see sales of 3,631 crores. All these numbers are in crores. In 2019, we see sales of 4,545 crores. Okay, interesting. In 2021, we see sales of 8,371 crores. Okay. In 2023, we see sales of 10,000 crores. All right. Then let's go all the way to 2025. We see sales of 19,551 crores. Operating profit of 528 crores. Operating profit margins close to 3%, more like 2.7%. Then profit before tax of 325 crores. And after paying a 24% effective tax rate, we get a profit after tax of 246 crores. So from sales alone, we can see there has been a very noticeable increase in the total number of sales. And to better understand how fast have the sales grown, let's see the numbers. Now, they don't have the 10-year numbers, so we only have the 5-year numbers. Over the last 5 years, the sales have grown at a compounded growth rate of 28%. Last 3 years, 23%, and last 12 months, last year, TTM is trailing 12 months, last 12 months, 29%. So massive sales growth. And profit growth over the last 5 years has been 67%. Last 3 years has been 26%, and TTM trailing 12 months has been 61%. So extremely massive profit growth, outpacing sales growth massively. So profit growth has outpaced sales growth massively, which shows operating leverage. Operating leverage, yes. Then let's come to return on equity. Here we see very stable return on equity. 5 years has been 24%. Last 3 years has been 23%, and last year was 27%. So very high return on equity along with very stable return on equity. So that was a summary of its financials. Okay, we can actually take a look at the cash flow. Here are the company's cash flows. Here we will focus on one number. Okay, cash flows from operating activity directly below me. Now, one thing you can see, the cash flows are very fluctuating. Like in 2016, it's 133 crores. The next 2 years, it's negative. The next few years, it goes back positive, 135 crores, 102 crores. Next year goes down massively. Then 2024, 2025, massive resurgence. So we can see the company has an ability to generate positive and big cash flow numbers. And we can see they're on the rise, but they're still very, very volatile. The cash the company can produce is still very, very volatile. All right. So that was the company's financials. Let's take a look at what the company actually does. So, what better place to be here than the company's annual report? Now, here they show their journey. Okay. Incorporated, you can see the yellow lines, incorporated in 2013, 2014. So fiscal year 2014, the company was incorporated in, all right, in 2016. So in 2016, 2017, in that year, the company had a capacity of 1600 TPD, just below me, okay? 1600 TPD. TPD is tons per day. So keep in mind this TPD number, okay? So 1600 TPD, tons per day, is the capacity in 2017. Then in 2021, the capacity is 3400 TPD, tons per day. So in 4 years from 2017, 2021, capacity has more than doubled. All right. And yes, then in 2023, 2024, it acquired, see, 1350 TPD edible oil refinery. So the one thing I want to show here is that the company is expanding its capacity a lot, by a lot, right? Its production capacity is increasing rapidly. That's what I wanted to show here in this segment. Now, let's continue. So moving on, we have the company's products. Here we have the company's products. First, we have edible oils. This accounts for, if I'm correct, the majority of its revenue. So edible oils, for cooking and all, and its byproducts are the major revenue source. And the big brand you can say is Vitalife. Vitalife is the big brand. So, okay, all right. What else do we have? Under edible oil, we have different types of oil: soybean, sunflower, palm oil. Palm oil is very important. And Vitalife, Mahek, Richfield, these are some of the brands. We will cover them. We will cover them absolutely. We have Vitalife. Um, okay, this is a bit. Then we have castor oil. Castor oil, I believe, is a type of non-edible oil. And here it's written that castor oil is used for industrial uses, pharmaceutical, and specialty uses. So it can be used in the pharmaceutical industry also. Okay, written right below me. So important thing we can learn here is that one of the products, castor oils, have number of non-food uses like pharmaceutical industry. All right. Then specialty fats. All right, we can read this. Another important product. A bakery focused range under Bisco Pride and Puff Pride includes tailored fats for cookies, biscuits, cakes, and puff pastries. All right. So to enhance the texture of cookies, pastries, biscuits, and all, cakes and all, we have some kind of specialty fats which Gokul Agro can produce. So we have pharmaceutical industry, we have cooking oil, edible oil, and then we have products, specialty fats for the bakery industry. So different number of industries are being covered. Then we have feed cake. All right, I think this is a byproduct of edible oil production. I'm not sure, but let's just consider it feed cake. Okay. Now, feed cakes, here it's written, products are widely used in coatings, cosmetics, lubricants, and specialty chemicals. So now we have even more diverse number of industries which the company's products can participate in. That's what we learn. Different and more, let's say, type of industries products can be used in, which provides us a more potential higher market place to which the company can sell to. All right. Then here it's written in the agri-allied space, our feed cakes provide essential nutrition for livestock and poultry. So another market, agri-allied space for livestock and poultry nutrition, feed cakes. Okay, okay. Then we have castor oil, their derivatives. Okay, you can read all of these, which are used in cosmetics, lubricants, specialty chemicals. All right. And these are the number of brands. We got Vitalife, we got Mahek, we got Pride, Bisco Pride, Puff Pride, Richfield, Sun Premium, and Palm Jyoti. All right. So different types of products. The most important, I believe, is edible oils. But you can see we got specialty fats, we got feed cakes, and the company has products provide, which can be sold to a different number of industries, wide number of industries. That's the important thing to consider here, in my opinion, what I'm trying to show. Then key performance indicators, we already saw this, but why not? Now these are in crores. You can read all these numbers. You can see all these numbers. Massive growth in revenues, massive growth in EBITDA. EBITDA reaching 500 crores. Then EBITDA margins, you can see are low, but are on the rise. See, 2.78 in fiscal year 2023, 2.87 in fiscal year 2025. All right. What is this? Yeah, this is EBITDA, and this is EBITDA margin. All right. This is profit after tax. Also risen massively, okay, this year. And before that, a bit of a stagnation, but now back on track. Now this stagnation was because that interest cost, its interest payments and depreciation actually rose a lot, which kind of subdued profit after tax. But we will talk about that. We will talk about the interest payments. Here we can see the profit after tax margin also on a rise, small falls, but on the rise. We can see return on capital employed took a dip in 2 years and is back on the rise. The dip can be maybe attributed to that its assets are expanding so rapidly. It's expanding its capacity so rapidly, so that return on capital employed, this figure, um, its denominator will have assets. So if assets increase very rapidly, then the denominator of ROCE formula rises a lot. And this is one of the best ROCE in the industry. Okay. Among all companies, maybe the best, or at least one of the best. The gross block shows the total number of assets, the total value of assets you can see has risen massively. See, 2023, 2024, massive increase, which can explain the ROCE declining. But I'm not sure. Please check on your own. Return on equity has seen rises and falls, but still, okay, 20% plus. It's reaching now 20% plus. Net worth, assets minus liabilities, has shown massive increase, and earnings per share, stagnation, then increase. Okay, at least stable, but now increased. All right, all right. So these are the key financials. Pretty much, let's say, on the rise. At least we can say they are on the rise. Then, then. Here they give some information. Now, this is for fiscal year 2025. The company said The company said that they acquired an edible oil refinery assets at Mangalore from Sri Anagar Refineries Private Limited. So they acquired even more edible oil refinery assets. And the edible oil capacity, the refining capacity, edible oil, has nearly doubled in recent years. So again, going massive capacity expansion. Then here they have showed end-to-end integration. Here they have said they have control over the full manufacturing life cycle from raw seed crushing all the way to refining and packaging. All right, all right. So now we have seen all this. It's time to see the company overview. Okay, the company overview part. And here I want to show one thing. What did I want to show? Yes, currently the company has a capacity, oil refining capacity of 6,250 tons per day, TPD. Remember, earlier we had seen the entire chart all the way from 1200. then to 3,400, 3,400 in 2021, fiscal year 2021. Now, 4 years later, it's 6,250 tons per day, the edible oil refining capacity. So that's the current capacity. 823 dealers, 36 countries, and 28 states. So it's saying now its products are available in 28 states. All right. Here it says average debtor cycle of under 15 days, which means when it lends products to its customers, it can receive the money in under 15 days. This is pretty common for the edible oil industry, but even then, its debtor days, I think, are one of the best. It can collect money from its customers, one of the fastest among all companies. And capacity utilization of 75%. Over the past 2 years, they said, at the refining and seed crushing units, but 75% is the uh, capacity utilization, which is, I think, a pretty good one. And finally, the company has given this that with rising business volumes, the company anticipates stronger cash flow generation, which will enable further deleveraging in the years ahead. So the company seems to have increased its debt a lot in recent years. A lot of debt means a lot of interest payments, way more interest payments, which made sure that the profit after tax we saw earlier, which had stagnated a bit, like 3 years stagnated, a lot of that was due to massive rising interest cost. But it seems it's now anticipating rising business volumes, so more cash being generated, and they will use that to pay down the debt. So maybe interest cost will stabilize, rise slowly, and maybe even come down. And of course, a lot of debt, this debt was taken to probably finance the capacity expansion. Do check that, but could be a main reason, nearly doubling production capacity. Now, finally, let's go to the balance sheet. All right. Balance sheet. Um, yes, balance sheet. Here we have the company's consolidated balance sheet. Now here, let's go to the current assets. Current assets. Correct? Current assets are assets which can be converted into cash within 1 year. Okay. So its total current assets are not given. Okay, they have not plussed it. I'm not gonna plus it. Here we can see cash and cash equivalents. All right. Okay. Okay, cash and cash equivalents. What are these numbers in again? Hold up, let me see. Okay, these numbers are in lakhs. These numbers are in lakhs rupees. So cash and cash equivalents here is 145 crores. So in the balance sheet, they have shown that they have 145 crores worth of cash and cash equivalents. All right, in the current assets. However, the current assets are dominated by inventory. Inventory refers to raw materials, finished goods, which are available for sale now, and goods still being manufactured. So its current assets is dominated by inventory, around 1,800 crores worth of inventory. So remember, debtor cycle was under 15 days. Okay. So inventory, a lot of finished goods, it can quickly sell. It can quickly sell the products. So that's why inventory is such a big part. Okay. Then current liabilities. I don't think they have given the total. Have they given the total? Yeah, they have not given the total. All right. In current liabilities, it's dominated by trade payables. Basically, suppliers give them supplies for raw materials on credit. On credit, okay? And we can see the massive 23, no, 2,300 crores worth of trade payables. This much money they have to pay back to their suppliers. So So I can't calculate the current ratio now. My fault. Now let's just see. We saw the balance sheet. We saw the cash that they actually have on the balance sheet, 149 crores. Not bad for 5,000 crore market cap. Now, finally, we have some important info that you're only gathered. Now here, I would like to see. Yes, these are some of the production capacities. 2021 was 2,100 TPD. 2024, it was mentioned 3,400 TPD. 2025 is what mentioned 6,250 TPD. Capacity utilizations across both periods 75%. Again, massive capacity utilization and capacity increase. Then, in the annual report of fiscal year 2024, they mentioned they have 550 dealers, okay, spanning 36 countries and 20 Indian states. But in the next financial report, okay, fiscal year 2025, they said the dealers are 823 dealers and distributors, 36 countries, and 28 states. So within 1 year, the annual reports said that not only the dealers went from 550 plus to 823, okay, their markets went from 20 Indian states to 28 Indian states. Okay. Then in fiscal year 2025 annual report, this line was, I copied it from the annual report, copy pasted. Here it says cash flow from operations declined due to increased working capital requirements, which aligns with the company's expansion strategy. With rising business volumes, the company anticipates stronger cash flow generation, which will enable further deleveraging in the years ahead. So right now they said cash flow declined, but this was according to strategy. This is according to the company's expansion strategy, which is good. So here, number of dealers increased. It went from 20 Indian states to now serving 28 Indian states. And cash flow decline was due to the strategy, was in accordance with the strategy. Then in fiscal year 2022, the annual report, there's a line mentioned 500 plus dealers. Then this went up to 575 plus dealers. So the dealers are increasing. Now, in the annual reports, fiscal year 2025 2024, there was no sales breakup given by product, which product is selling how much, okay, which country, how much sales is coming from exports and all that. So in fiscal year 2022, this is from their annual report, 10% of revenue came from exports. 10% of revenue came from exports. Then here is breakup of sales for fiscal year 2023, the annual report. For 2024, 2025, they have not given the breakup of sales. Here you can see that edible oils and byproducts dominates. 88% of sales came from edible oils and their byproducts in fiscal year 2023 and even 2022. So I'm supposing that in the next 2 years, it has not changed much. So supposing that, I'm just making assumption that 88% of sales, or still 85% plus of sales comes from edible oils. Okay. Then here we show the domestic sales and export sales, almost 10%, 9.8 something percent. You can see export sales are given. This breakup is not even given for, what do we say, fiscal year 2025. So a bit of an L. But if you can see fiscal year 2023, this is around 987 crores worth of sale came from exports and 9,070 crores of sales came from domestic. All right. Now finally, one more thing to show is credit report. Credit report. Now this is a credit report of the company, okay? Published by a credit agency. Which credit agency? Chrysler. You can see, Chrysler, very reputed. They have given it an A, okay? Short-term rating is A1, and this has been upgraded. Okay, so ratings for long-term loans and short-term loans have both been upgraded. Give better rating. It has been given better rating. Um, Here I want to show one thing. Now they have mentioned this. Okay. See, top five clients, top five clients contribute 20 to 25% of overall revenue. So this is by the credit report. So 20 to 25% of overall revenue comes from, wait, top five clients contribute only about 20 to 25% of overall revenue. Okay, so maybe not the most concentration client risk. Then there was one more thing I want to mention. Yes, the group generates 90 to 95% of its revenue through palm, soya, and sunflower oil. Contribution of palm oil was 40% in fiscal year 2025, down from 53% in fiscal 2024. So three things: palm oil, sunflower, and soya oil. 90 to 95% of revenue. 40% of total revenue coming from palm oil. So palm oil is the big thing. All right, all right. And that was it. And company derives 5 to 10% of its revenue from export of soya and mustard oil. Hmm. So that was it. That was all the information to be provided or I could provide. So 40% of revenue comes from palm oil. So as a summary, what even is Gokul Agro? Company which has grown rapidly, has expanded its production capacity rapidly, 75% capacity utilization, okay, massive increase in profits, even cash flows the company can generate, and massively dependent, like 85% plus sales we saw only 2 years ago, or 88% of sales only 2 years ago came from edible oil products, with the credit report mentioning 40% of sales coming from palm oil. I think that's it. That's all we've seen about Gokul Agro. I think massively outgrew the competition, grown way faster than competition, with around 5 to 10% of sales coming from exports. The number of dealers have been consistently increasing. And I think I can show one more thing. This is the profit and loss seen earlier. Pay attention to interest. Okay, pay attention to interest, this component, and pay attention to operating profit. And we will divide them. Operating profit divided by interest. So 40 crores in 2016 compared 53 crores, that's 1 point something. 53 crores, 84 crores. Okay. Then let's move to, yeah, 2021, 62 crores and 141 crores. Two. Now, operating profit divided by interest is interest coverage ratio. If it's less than one, it's concerning. Slightly more than one, okay. Two, three, four, way better. Way better. Now, interest has increased rapidly for this company in the past few years. Okay. The line directly below me. See, 2022 interest payments of 56 crores increased to 118 crores in 2024, and 2025 reached 183 crores. So massive increase in interest, which led to profit after tax not really increasing a lot, correct? It's profit after tax stagnation. But latest 528 crores of operating profit divided by 183 crores of interest. So 528 minus 183 gives us 2.88, which is on the better side, on the better side. So 2.8 is the interest coverage ratio, seems to be showing improvement, yes, compared to last year's, like 120 divided by 84 was. So on the better side, interest coverage ratio. So that was it. That was Gokul Agro Resources. Good cash flows, I see.